Welcome back. Today we're going to talk about gold, why it has a place in every portfolio, why it's going to make new all-time highs this year, why this is the start of the new super cycle, and we're going to compare it to the 40s and to the 70s. Let's dive in. And here we go, deep dive into gold. Let's start off with a quote from Ray Dalio. He's the creator of the all-weather portfolio, and he's advocating for a 7.5 to 10% allocation into gold. I'm going to make the argument why this allocation is probably too small, and you should have a bigger allocation, especially in the times we are in right now. But nevertheless, Ray Dalio is a very wise man and one of the best investors ever, probably. Like right there on the level of Warren Buffett, Steve Druckenmiller, and others. Short disclaimer, you can pause the video to read the full one, or you can go down into the description. First of all, before we go into gold, remember in my last video, I explained the last 10 years, 12 years, which we have seen an exceptional bull run in stocks and indexes. This is the S&P 500 over the last 12 years. And since the great financial crisis in 2008, we saw a 600% increase. So many are still dollar cost averaging into this. Just remember, a normal correction within a recession or within an economic downtrend, as we saw in the great financial crisis, we saw a downturn of almost 60%, which is completely in the normal range. After that, we saw a bull run with two setbacks. One was during the pandemic, which was a 35% V-shaped recovery, where we saw money printing. The Fed printed $3 trillion in 13 weeks, which is completely crazy. And then we saw the bear market since about a year. We saw a retracement of 26%. Currently, we are down 14%. And I would make the argument, if you're dollar cost averaging into stocks, you're probably buying a top. So, but this video is not about stocks. This is about gold. And let's dive into, so this is the allocation that Ray Dalio suggests. 30% stocks, 7.5% gold, 7.5% commodities. So I feel right now this should probably be a bigger allocation. I'm going to make the argument why. We touched on bonds, why it was considered a risk-free return for the last 70 years. Right now, I would say it is return-free risk because of inflation. Like last year, for example, we had inflation of 10%, and you're going to make 5% with bonds. So net negative, you're losing 5%. And you're taking a risk, because if a government needs to default on its currency, a bond is pretty much worthless. So how to structure a portfolio that it is, in my mind, crisis-proof. And going into a recession, this is probably one of the strongest portfolios you can have right now. 25% into stocks, and there you probably don't want to be in an S&P 500 index that had a 10-year bull market, but you want to be in sectors and you want to be in regions. Watch my last video if you haven't seen it yet. I'm touching on demographic trends and why you probably want to be in those sectors and in those regions. So you want to have cash. Going into a recession, everybody's expecting an economic downturn. The one who has cash in a recession is king. You can scoop up cheap assets and you can find good entries. And the other two allocations I personally prefer are hard monies. We have two of them. One is gold, which we're talking in this video. The other one is Bitcoin. I'm not going to touch on Bitcoin this video. It's going to be its separate video. So let's look at some charts. Before we dive into it, I'm going to give you the overview, what happened during the last 10 years, and then we're going to deep dive into long charts, 70 years, 100 years. So let's look at the history first. So this is 2005 until 2023. And gold saw an exceptional bull run. We're going to deep dive into this area where you can see from the Dotcom into the great financial crisis and the top afterwards. And since then, so the great financial crisis is right around that area. And right now we are holding up quite nicely, slightly below the new all-time high. The last 10 years were practically flat on gold. So you can see here, 2011 were pretty much the same prices as we have today. And this is exactly why gold is such a great opportunity over the coming decade. Let's look at a larger scale in history. And this chart illustrates the ratio between gold and the S&P 500. And you can see three great peaks on this chart. So one was during the 70s, which was considered an oil crisis. And we had a very, very similar setup in the 70s as we have it right now. And you will be blown away on how similar these two periods are. Next was the Gulf crisis in the 90s, and then we had the great financial crisis in 2008. And all of these times, gold did exceptionally well. And you can see right now, we have three bottoms here, and we are at a super low ratio. Comparing the S&P 500 to gold, it's probably never has been a greater time to get into gold. So commodities, gold is valued exceptionally low compared to the S&P 500 and stocks. Let's look at another chart. This illustrates the last 100 years, and this is not on a logarithmic scale, so it's a little bit different, but it's pretty much the same illustration. So here we had the 30s and the 40s, which after the Great Depression, you could see gold doing exceptionally well and holding up great. And here you have the period during the 70s. And right now, we had, in 2001, you had the whole Dotcom area, the whole bull market there, where gold actually didn't perform that well. But as soon as the bubble burst, the Nasdaq needed 13 years to make a new all-time high, and gold started to perform greatly from then on out. And I make the argument that we are in a similar period right now. If you could make the decision going into gold or going into an S&P 500 index, you're probably going to end up outperforming, at least for the coming few years. So right now I'm going to show you a few things. So, and you just bear with me. So high level of government debt. Expandatory monetary policy, meaning money printing, the M2 money supply going parabolic pretty much, economic uncertainty, inflation and debasement, significant fluctuations in commodity prices like natural gas, like oil, and so on, and supply chain disruptions. You probably guess that I'm talking about the times we are in right now. But I'm not. I'm talking about the 70s. These were the major things that shaped the 70s. So from 1970 until 1980. In this time, gold was by far the best performing asset of this decade. And just looking at these few lines that I wrote down here, I'm 100% sure you thought I'm talking about the 2020s, the time we're in right now. And now we're going to compare the 70s and today. So what did gold do in the 70s? We did 2,200% run up. And the 70s was, Paul Volcker was the guy that really raised the rates and fought inflation. And during that time, so of course, 71 was also the year where we went off of the gold standard, and gold had its biggest run up in the last 50 years. And I'm making the argument that right now and in the 70s, we pretty much have the exact same setup. And nobody's expecting it. Everybody is talking about growth stocks. Everybody is talking about new trends like AI and biotech and things like that. And while I give complete validity to all of these trends, probably not within the next 2 to 3 years, because we first need to have some pain in the markets first. So setup very similar than in the 70s. Let's compare it to Dotcom and great financial crisis. So during the Dotcom area, especially when there was the strong run-up, we had a 40% correction in gold. But after that, right when the bubble burst, 300% run-up. Great financial crisis, 30% correction. Gold was the first to rise after the crisis. But these rises, they don't happen without hiccups in between. And we saw a strong hiccup in gold here, a 30% correction with another 170% push the years after. And usually these commodity trends, these gold trends, they are at least 2 to 3 years, sometimes longer. So my expectation here as well is if we go into the future, we're probably going to see 2 to 3 years, maybe more, where gold is having a tremendous bull market. All the way in the end of this video, I'm going to show you a chart with my price targets and my expectations, technical setups, fundamentals, everything on where I think gold is going to be headed. But first, so you have seen all of these charts that illustrate how history worked until now. And the absolute worst thing you can do as an investor, the 4 most dangerous words an investor are, this time it's different. But it's probably not. Sir John Templeton, he was a great investor and a very old, very wise man. I think he died 12 years ago or so, but he experienced the whole period in the 50s, 70s, 90s, and is a very, very wise man. So I probably don't need to tell anybody that gold is a great inflation hedge, but just for illustration purposes, I'm going to show you a few charts there and a few illustrations. So purchasing power. During the last 100 years, the US dollar lost 96% of its value. This is perfectly illustrated here. And gold has gained about 7,000% purchasing power, which is pretty crazy. It's not just that this is an inflation hedge, but it's also an investment. A lot of people say you will just be able to recuperate, but it's actually outperforming. So here, to illustrate this with an image, back in 1933, you could buy, with $20, you could buy a golden coin, 1 ounce golden coin, and right now there is bundles of cash needed to do the same. Let's go into, I know for a fact that some Germans are watching this, and at the Oktoberfest in Germany, if you compare the beer price, this is the blue line for 1 mass of beer in euros from 1950 to now. The blue line is rising like crazy, so a beer is costing more and more every year. In gold, it's actually decreasing. So most of the time it's flat, but over the long run, you're actually getting more beer for your buck, which is great. So next, and one of the most important things, why gold is headed for a new super cycle, central banks. So here is an illustration on which central banks actually hold the most. And I'm going to illustrate this a little bit better because in this chart, it's not really fair and you don't see the changes. And the changes in central bank gold balances is the important thing we need to touch on here. So you have the US, which has the most gold, at least they claim. Nobody knows how much gold actually is in Fort Knox, but on this chart and what they share with us, transparent, they have the most. Germany, also decent amount, but both of them are net zero, more or less, a few percentages. Italy, no changes. So here we go into the interesting part of this chart. China had 400% increase in their gold reserves. Russia, 400% increase. India, almost 100% increase. So you see all these countries that are economically in the east and want to move away from the US dollar, they are stocking up on their gold massively. And this is an ongoing trend. Now, I illustrated a few charts. We had the comparison to the 70s, we had some technical charts, we had the inflation argument, central bank argument. Now, if you want to get gold exposure, what is the way to do and how is the way to do that? So you have the junior miners ETF. If you want to take high risks and be greatly rewarded, this is probably the way to go. I wouldn't advise putting big capital into this is GDXJ. There's a miner index and these miner indexes are extremely volatile. But if you want to leverage your gold bet, this is probably the way to go. If you're conservative like me, you want to do 2 things. So the first thing is this is GLD. This is a physically gold-backed ETF and probably one of the biggest, most liquid investment vehicles you can choose to invest in gold. It's traded on Interactive Brokers, on the Giros, on every investment platform out there. You can probably buy GLD. If not, drop me a DM or ask in the Telegram group. I can link you up to an exchange or to a platform that you will be able to buy that. So GLD, if you want to buy paper gold, physically backed. What I personally do, I'm originally from Switzerland. I buy, it's called Goldvreneli, so you can get 20 gram coins in Switzerland by almost every bank. And it's always, so physical gold is always better than paper gold. Just because you can keep it at home, you can keep it at a vault in a bank. But just in case things really go south, you have physical coins to trade with, and it feels great to store them, to own them, to touch them, to have them. This is one of the elements why gold is so superior. Here in Europe and in the United States, the younger generation have lost touch with physical gold, and it's not really a thing. But if you go into other parts of the world, like Russia, India, China, culturally, gold is still valued greatly. And there's a reason why most of our like wedding rings or jewelry or other things are still made of gold. And it still has a very high recognition and is valued socially. Yeah, but Fabio, what if we found gold reserves in the deep sea that nobody knows about, like a big gold mine? Yes, while this is probably possible that we have new instruments and we found these big gold reserves, the issue there is the difficulty in mining is, if this is underwater, you need to expend so much money in machinery, in oil, in getting it out, that there is almost no break even. And a lot of people say, yeah, we don't know how much gold is in the world. We have a fair amount of knowledge on how much gold there is. And there might be, deep down under the earth, there might be more reserves. But the issue there is, the deeper you need to go, the more money and the more resources you need to expand. And gold has about an inflation rate of 2% a year. And this was true for almost 100 years. And it never changed. And while maybe we will discover more gold reserves, but they are not near to the ground or not near to a good spot where you actually can go and mine for it. And now there is, of course, the futurist among you that say, yeah, but hey, we're gonna mine asteroids. There is so much gold in space. We're gonna bring it back, and then gold will be greatly inflated. And sorry to tell you here, but we're far, far away from that, because it needs to be economical. And right now, it is so expensive to go to space, to launch probes, to actually mine an asteroid. It never has been done before, and it's probably not going to be done within the next 10 years. Maybe this is going to change in 10 years, in 20 years, but what I'm talking about here now is a trend over the next 5 years, maybe 10 years. And with this amount, in this amount of period, you probably are not going to mine any asteroid sometime soon. Okay, technical setups and fundamentals. These areas here, one in the 70s, one in the 00s, and one right now, they're called cup and handle formations, which is practically a redistribution period where a lot of people try to find their entries with exceptional breakouts. I'm going to explain in a bit how they look like and how they play out with my price targets. So this is how a cup and handle looks. You can see this is the cup, this is the handle. And usually the price target is about the depth of the handle in minimum price on the upside. So you can see that here. And now let's go into the chart and look how exactly this looks like. So cup and handle formation, 2011, 2020. This is the cup, this is the depth of the cup, green line, and this is the handle. This is probably going to play out like this. It could be that we are going to go into the direction of 1500, because as you have seen in the chart I showed you earlier, when we have economic downtrends, we have a sort of liquidity crisis. So people need to liquidate their assets to get into cash. Maybe they lose their jobs, maybe they need some cash to buy a car. In a recession, people tend to liquidate their assets, and gold is an asset that people hold, so it is not immune to these first initial liquidity crises. But always, as historically at least, gold is the first to recover, and it recovers very, very strong. So I'm gonna guess we're gonna see a little bit more downside, maybe a little bit of zigzag sideways until maybe the end of this year into the next year, probably earlier. And then after that, we can see if we are extending this green line, we are going to get almost into the 4,000 USD area. And in my opinion, this is a conservative price target for gold. We could go much higher. So with that said, this is not financial advice. This is my personal strategy. I personally own a lot of gold. About a third of my portfolio currently is allocated into gold, and I'm going to keep accumulating gold over the coming year or so until we break all-time highs. And also there, part physical gold, part paper gold. So we came to the end of this video. If you haven't watched my first video where I give a bird's eye perspective overview, stocks, commodities, Bitcoin, I touch on housing, go watch that. And after this one, I'm probably going to do dives into housing, what happened in 1971. We're going to touch on overpopulation. We're going to touch on all kinds of different things. I'm going to make polls on the community tab from this channel, and I'm going to ask you guys on Telegram what kind of topics you want to have covered. So make sure to subscribe to the channel. Thanks for tuning in, sticking around to the end, and I hope you enjoyed this episode. There was something to take along, and I'm going to see you next time.